Welcome back to another lecture series of Financial Derivative and Risk Management. You are watching UN College Digital Classes, an digital platform of Udayanath Autonomous College of Science and Technology situated at Adaspur in the district of Cuttack in the state of Odisha. So, we are discussing the financial derivatives and we have discussed many things till date, and in our previous class we had discussed on the interest rate future, and that is a very interesting one which we have discussed in our last class. So, if you will consider, and if you are into finance and you have some interest in finance, you must be knowing that the currency of each country differs from each other. And the value of a currency with respect to other currency or a currency of another country differs the value of that currency. So, this difference in the value of currency is dependent on, or that is relied on many things like the demand and supply, the central bank policies, and many other factors are there which is deciding the value of the currency of a particular country. So, this currency price is fluctuating, and we can say that there is time to time change in the value of the currency of a particular country in relation to other countries' currency. And the investors, those who are taking interest in investing, they took much interest in the currencies of those countries who have a stable and robust currency value. And we can say, for example, that US dollar is a strong currency on which most of the investors are relying on, or the most of the investors take their interest to trade on that currency. So, what is this currency funda, and what is this currency exchange, what is this Forex, and what is this currency, and how we can trade on this currency value taking as an underlying asset in financial derivative also. So, in today's class we are going to discuss on that very interesting topic of currency futures. So, without much delay, let us start our class of today, that is the currency futures. So, the investors enter into currency futures contracts to protect themselves against currency risks. And a currency future is a futures contract to exchange one currency for another at a specified date in the future at a price that is fixed on the purchase date. And it also referred to as foreign exchange futures, or FX futures for short, are a type of futures contract to exchange a currency for another at a fixed exchange rate on a specific date in the future. So, these contracts are standardized and traded on centralized exchanges, and these currency futures can be used for hedging or speculating purposes. And due to the high liquidity and ability to leverage the position, speculators will often use currency futures over currency forwards. So, as we know that when we are talking of a financial derivative, definitely we are taking an underlying asset, and on the underlying asset that we are taking, accordingly we are naming the financial derivative, or that is the one financial instrument on which we are taking the derivative contract. So, when we are talking of the currency futures, it is a future contract which we are taking on the differential rates, or we can say the currency value or the exchange rate of the currency. And as we know that there is lot of fluctuation in the currency's rate, or we can say that there is a much high risk in this, then the traders would like to hedge their position, or they also will speculate on this underlying asset, that is the currencies. Look on the basics of currency futures, on its emergence and its development. So, the first currency futures contract was created at the Chicago Mercantile Exchange in 1972. So, as we can say that this Chicago Mercantile Exchange is the first who introduced this currency exchange funda. And you will want to know that this is the world's largest exchange for currency futures till date. Today also it is the largest one. The Chicago Mercantile Exchange is the largest one dealing with this financial derivative. So, the currency futures contracts are mark to market daily, and this means that the traders are responsible for having enough capital in their account to cover margins and losses which results after taking the position. So, futures traders can exit their obligations to buy or sell the currency prior to the contract's delivery date also, and this is done by closing out the position except for contracts that involve the Mexican peso and South African rand. Currency futures contracts are physically delivered 4 times in a year on the third Wednesday of March, June, September and December. So, this is what the basics of currency futures is. Let us have a look on the components of the foreign exchange futures contracts. So, what are the components? Let us discuss that. It has an underlying assets as any other financial derivative, and this is the specified currency exchange rate. So, in the currency futures, the specified currency exchange rate is the underlying asset on which we are taking the contract. It also has an expiration date. For cash settled futures, this is the last time it is settled, and for physically delivered futures, this is the date the currency are exchanged. So, this is the 2 parameters on which we are taking the expiration date of the futures contract. Then the size of the contract size are standardized. So, different exchanges have different standardized contract size on which these currency futures are being taken. And also, as other future contracts, these currency futures are also required to deposit a margin amount, and to enter into a futures contract an initial margin is required, and a maintenance margin will also be established, and if the initial margin falls below this point, a margin call will happen. Beginning the trader or investor must deposit money to bring it above the maintenance margin. So, these are the components that the foreign exchange futures contracts is having. So, as other future contracts, as we have already discussed, then when we are taking a future contract, there are certain parameters which we need to follow, and in futures contracts of currency, or in currency futures what we are saying, that or Forex futures what we are saying, in that also these components are involved, that we have an underlying asset, we have a lot size or a particular size, we have to deposit a margin amount, and also we are taking the contract for a particular period of time, or we are fixing the expiry date at the time when we are taking the contract. So, these are the different components that are there with the Forex exchange contract also. Let us see what are the contract types. So, there are a wide variety of currency futures contract are available, and apart from the popular contracts such as the euro dollar, there are also e-micro Forex futures contracts that trade at 1/10 the size of regular currency futures contracts, as well as emerging market currency pairs such as the PLN or USD, that is Polish zloty or US dollar futures contract, and the Russian ruble or US dollar futures contracts are also available. And different contracts trade with varying degree of liquidity. So, these are the different contract types, so that what we are saying, that it is not limited to a huge amount, or it is not limited to the wholesome amount. It can also be traded at 1/10 of size at the micro levels also, and it is traded of different currencies exchanges. So, this is what the types of contracts are in the currency futures. Now, we will see the difference between the spot rate and the future rate of currency futures. So, the currency spot rate is the current quoted rate that a currency in exchange for another currency can be bought or sold at. So, that is what the currency spot rate is. And the two currencies involved are called a pair. So, the two currencies that we are involving in the currency futures contract, they are called as a pair. And if an investor or hedger conducts a trade at the currency spot rate, the exchange of currencies takes place at the point at which the trade took place or shortly after the trade. So, this is what happens, and since currency forward rates are based on the currency spot rate, currency futures tend to change at the spot rates changes. So, as the rate changes in the spot, the futures rate also changes. And if the spot rate of a currency pair increase, the futures prices of a currency pair have a high probability of increasing. So, if the spot rate is increasing, so there is a high chance, or we can say the probability is high, that the future prices of the pairing currency will also go high. And on the other hand, if the spot rate of currency pair decreases, the futures prices have a high probability of decreasing. So, this is what we can say, that there is a direct proportion of the pairing currencies. So, when there is increase in the spot price of a pairing currency, then definitely the other will also high probability of going up, and when one is going down, there is probability that the other pairing currency will go down. So, this is what the relationship is. And sometimes the spot rate may also move, but futures that expire at a distant date may not, and this is because the spot rate move may be viewed as a temporary or short term, and thus is unlikely to affect long term prices. So, these long term prices are sometimes are not affected because the distant date that we are taking, that is not getting affected by the variation in the spot rate of the currency. So, this is what we can say that currency future is. There is a lot chance, and many a time people get confused between the currency futures and the forex. So, let us have a look on what this currency future is and what this forex is, and what is the difference between the currency futures and the forex. So, both currency futures and forex are based on foreign exchange rates, definitely. However, there are many differences between the two, that is the currency futures and the forex. So, let us have a look on the differences that the currency futures and the forex have. The forex spot market is the largest market in the world, and the currency futures trade at a fraction of the volume, with many currency futures contracts trading under high volume and good liquidity. So, we can say that the forex spot market is a very large market, or it is the largest market in the world, but the currency futures are trading on just a fraction of the volume, just on a few currencies, or on a portion of the forex market this currency futures market is trading. Another difference is that the currency futures are exchange traded and are regulated like other futures market. As we know that when we are talking of the financial derivatives and we are talking of futures in particular, we know that they are exchange traded, and unlike the currency futures are also exchange traded and are regulated like the other futures market. But forex has less regulation and trading is conducted over the counter through forex dealer. So, this is a big difference between the futures contract and the forex market. We can say that the currency futures are traded in the futures market in a exchange on a regulated way, whereas the forex is traded over the counter, and there is no central marketplace for forex. We can differentiate the forex and currency futures, that the currency futures can be traded using modest leverage, and Forex offers the ability to trade with a great deal of leverage, leading to large wins and of course large losses. So, while we can say that the currency futures are a modest leverage, Forex are not having that. There is a high chance of winning, at the same time there is a large chance of losing also. And if we talk of the tax treatment for profits and losses incurred from currency futures trading and Forex trading may differ, and depending on the particular situation. So, according to the situation and according to the trade that we are doing, the tax treatment of the currency futures and the Forex trades differs from each other. Another thing is the commissions and fees, that also differs, that currency futures typically involve a commission that is to be paid to the broker, and other various exchange fees that are to be given while we are trading in the financial derivative market, or we are doing that futures trading. We have to give various exchange fees, various commissions, and all these fees are there, which will be incurred by the currency futures. Though the Forex traders do not pay these commissions and fees, they are subject to exchange rate spreads through which the Forex dealer get the profit. They are not going to pay any commission, or they are not going any other charges as the currency futures traders are paying for the trading that they are doing in the exchange. So, this is what is a very interesting financial derivative type we have discussed, that is taken on the underlying asset, that is a currency, and the two currency that we are taking this financial derivative on are called as a pair. So, when there is difference in the price of the pairs, this risk is covered up by taking a financial derivative, that is the currency futures. And these currency futures have very distinct features as we have discussed, and these currency futures are different from Forex definitely, and there are high chances that many of time we get confused between this Forex and currency futures, and but these currency futures and Forex are quite different. This Forex is a very wide market, but it is not a regulated market and not traded on an exchange, rather it is traded over the counter, while the currency future we are trading on an exchange like other future contracts. And in currency futures also we need to give some commissions, and we need to give various fees, and which the Forex market is deprived of. There we are just, the dealers are getting profit out of the difference of the currency prices. Like that we have discussed many things in today's class, and I hope and believe that you people have understood that what this currency futures is and how it works. In our upcoming classes we will be discussing many other such financial derivative topics. So, keep watching. Thank you.